I'm sometimes asked, is it possible to avoid corporation tax by just registering the company abroad? So you're a company, you're transacting in the UK, you're doing your business, you're doing well, and you would like to pay less tax. Who wouldn't? And someone possibly has suggested to you, if you register your company in a low tax environment or a nil tax environment, then your company is set up there. It's not a UK company. The profits flow into that company, which is registered abroad in a low tax environment, and you don't pay any corporation tax. How about that? Well, it's a little more difficult than that, as you probably would expect. The first thing to consider is you will be a UK resident company for tax purposes if your central management and control is in the UK. So central management and control, what does that mean? It's driven from the UK, it's managed from the UK. The directors run the company day to day from the UK. So central management and control. So if that's where the heart of the business is and where it's controlled from, then even if you satisfy the conditions for registration in and residence in that low or no tax environment, you will still be resident for tax purposes in the UK because your central management and control is here. It's a kind of substance over form test. So say even that you could have your central management and control abroad. You could contrive somehow to do that, which is going to be difficult for most companies that actually do their work and activity here. Then you have to overcome the point that if you have a permanent establishment here, that means a place where you do your business, a factory, an office, or whatever, you have a permanent establishment here, or you're doing your work through what's called a dependent agent, someone who transacts for you here and exclusively for you here. And you have economic activity here, so that you actually trade with people, you do work here. Not just you have customers in the UK, but you're actually working with them here, you're transacting with them here. So those two tests also, permanent residence and economic activity, will also need to be overcome if you're going to avoid UK corporation tax. Bear in mind, of course, and I'd reiterate this, first of all, if you have your central management controller, you're resident here anyway. So you need to avoid that first, which is hard, and then have no permanent establishment or economic activity here. And then you need to consider, since 2015, we've had what is known as the Diverted Profits Tax. So this was the UK in the shape of, who was it, the Chancellor at the time, George Osborne, who was saying, actually, we're going to get ahead of the curve with the EU and the OECD have been looking very closely at what's called base erosion. So they're looking at how companies have shifted their profits around the world to minimise the tax when they're actually doing their business in a particular location. And there will be some pretty powerful legislation to emerge from that. But the UK got ahead of the curve in 2015 with diverted profits tax. Now, it only applies to big multinational global companies, so it's not something that small companies really need to consider, but it does exist. And it means that if you are transacting with UK individuals, and effectively you're doing your work with UK individuals, wherever you're set up, if your economic activity is in the UK, you are going to pay the diverted profits tax. Or if you're a UK company and you're doing your work here, but you, through multinational structuring, you're having the profits emerging in a lower tax jurisdiction, but your economic activity is in the UK, then the diverted profits tax will apply. And they've set it at a rate that will encourage you to not try to do that and just pay the ordinary corporation tax rate, which is 19%, going down to 17% in 2020. So the diverted profits tax, penalty tax, effectively, is at 25%. What we also have, and this again is for multinationals and globals to consider, is the consultation that's going on in relation to digital services tax. Now, because of the way people transact, the way we all live these days, just where a business is and where its economic activity is when it's an online business is quite tricky to sort of track where should the tax really be paid. So if you consider the behemoths that we all know and probably love, Amazon, Google, Facebook, then where are their profits generated? Clearly, loads of people in the UK use those social media platforms, those search engines, those marketplaces to do business and transact. But the businesses themselves are often set up outside the UK, or a part of their business is in the UK, but the majority of the profit that emerges from doing business with people in the UK doesn't flow into the UK and therefore isn't taxed in the UK. So the digital services tax is proposed at 2% until the OECD gets its act together. Again, the UK being ahead of the curve. Philip Hammond this time is saying, look, we've got a consultation and we aim to implement this by 2020. Again, for globals, small businesses don't need to concern themselves with it, but they're really looking at those big businesses and the amount of money that's generated from transactions with people in the UK to say, okay, we want our share of that. And it's proposed at 2% on revenue generated with UK users of those social media platforms, marketplaces and search engines. Obviously a bit of work to be done on how you work out that tax and what transactions are covered and what aren't and all the rest of it, but it's out there, the consultation is going on, obviously lots of representations are being made, but you can see there that those three things, first of all, the basic principles of central management and control, economic activity and permanent establishment, means that for most small businesses, doing their work in the UK with customers in the UK, it's not possible to avoid UK corporation tax by merely registering abroad. Then you've got the more global businesses being concerned with, rightly, the Diverted Profits Tax, where you're seeking to shift profits, the emergence of profits outside of the UK. And then you've got the consultation on the Digital Services Tax applied to the well-known global businesses who are transacting, having economic activity with UK users, and the revenue think probably aren't paying enough to HMRC. We need our share. And it's scheduled to generate a fair bit of tax. And then we'll get whatever the OEC does afterwards. So it's seen, actually, the Digital Services Tax as a sort of temporary sort of stopgap until we get the OECD rules. So a bit of an update on corporate, and basically with this whole thing of register abroad and don't pay any tax, the old adage really rings true. If it seems too good to be true, it probably is. Of course, TechLink isn't too good to be true, so go there to read the bulletins for a bit more detail on all that stuff I've just talked about.